Hi, this is Nahid Roni, and I'm going to say about something investment analysis, which is our Level 7 Finance for Strategic Managers unit, and then we are going to discuss about learning objective 3. So today is discussion about the investment analysis, and our aims and objectives of today's session is we will discuss something about the capital investment appraisal techniques, which is typically called the investment appraisal. And discussion on the payback period, which is called PVP, ARR, accounting rate of return, annual return, the net present value, and PV, and internal rate of return. And then we will discuss something about the break-even point today, because this is a one kind of investment appraisal techniques which is heavily used in the business industry. And then objectives of today's session is what is meant for actually the investment appraisal, and different kinds of investment appraisals are going to be discussed. And again, we will discuss about the break-even point analysis. So what we do know, actually, the investment appraisal. Investment appraisal is a business concept. It's very much as a business concept and feasibility study of the project, which compares expected future income to be derived from an investment where money were invested with the expenditure of incurring the investment. In the non-profit making organization where investments are not made to with the objective of earning a return, therefore the concept may not always be directly applicable, but sometimes it needs to be assured that how much cost involved and how long it will be continue about that project. So in such organization, investment appraisal techniques may be used to compare alternative proposal in order to provide the best value for the money spent. And it has already been researched. So investment appraisal is used to look at the potential capital investment by a firm and measure its potential value and the cost of capital of the firm. There is more than one method of investment appraisal, as I said, that NPV, ARR, and payback period, and each different method allows the potential return on the investment to be examined in the different way and techniques. So, for example, let's see, decide on the total project requirements over some period of years, like 1 year, 3 years, 5 years, 7 years, or 10 years. And then how we can think about that, how far a company looks ahead depends upon its size and type of the business, and if it is on the several year project requirements. Examine the capital cost of each product by the project financial appraisal. We can do that, and therefore a schedule can be drawn onto the plot, and the capital outlay of each project is in each year ahead. So this will show the total yearly outlays of the capital projects. So the capital available this year may be adequate, but the capital in future years may be reduced for many reasons. So future capital availability needs to be taken into consideration. That's called capital rationing. And also calculate the best capital projects by the rate of return ranking, because of the capital rationing may include inability to borrow, caution to restrict borrowed money, rich and family atmosphere, and other things. So that has to be considered of the rate of return ranking. So there are 4 techniques I'm going to discuss today. There's the payback period, accounting or annual rate of return, we call it annual rate of return, sometimes it's called accounting rate of return, net present value, and the internal rate of return. And why need this kind of investment analysis? Because there are some financial control procedures in the business and industry, mostly important in the internal management. For example, if we divide or segregate the duties of the employees and the department, we need this kind of budget forecasting, financial control procedures, organizational controls. We need to know the delegation of the authority, authorization, and approval. We need to know about the physical controls of the financial investment, supervision and personal and the HR distribution and arithmetical procedure and management controls we need to do for the financial control procedure for the company. So now let's move on the investment analysis of the different tech tools and techniques. First is payback period, and that means the amount of time taken for the net cash flow resulting from an investment to a match equal to the initial cost of investment. So the typical formula is initial investment divided by annual cash flow. So there is a no discounting factor as well. So this formula is only applicable if equal cash flows are maintaining in the company. So there is a no discounting factors here. So the advantage of the payback period is very simple to use. They're very easy to use, and it assists with cash flow. It recognizes value of receiving return quickly, therefore it reduces the risk. It's very effective when the technology is too fast, and it's changing phenomena because of it ignores the return after payback. So these are the pros and advantages of using the payback method in the company, and then disadvantage and cons of the payback method is ignores flows of cash over the lifetime of the project, and ignores the total profitability. Sometimes it's confuse the profit figure when we measure the payback period over the year. And let's see one example. For example, company installs a vending machine at a cost of £3,200, which would generate income at £1,000 per year. And then running cost every year is £600. So what will be the payback period? So method is very simple. It's divide cost by the net yearly cash flow. And then we are not considering depreciation here. So the 4 years payback period, the company has expected income and cost excluding depreciation. We are not considering depreciation here from project costing £3,000, and then income from the first year is 1,500 and costs 2,000, and the cash flow is coming in 500 negative, and then cumulative cash flow is 500. So these are the cash inflow. So income, sales are coming here, and then cost is here. It's because of the £600 fixed cost, and other cost is associated with here. And then cumulative cash flow is the previous cumulative figure is plus equals 1,000, because here is a 1,500 and that's negative 500. That's 100,000. 1,500 last year is 1,000. That's a 2,500, and then 2,000. Because we are expecting the project costing £3,000, so somewhere here is our payback period. So 2,500 and 4,500, our payback period is nearly 3.5 years. Because we are seeing the projected time, so there will be the time will be here in between these figures. So our projected time is a 3.5 years. So calculated cumulative net cash flow method is using to calculate the payback period here. So this is 3.5 years. We are calculated payback period by the using cash flow and cumulative cash flow method. So payback basically assumption is the cash flows that come in evenly as equally throughout the year. So cash flow, the profit before the depreciation is always considering, it's always before the depreciation of the machineries, and the payback month can therefore be estimated based on the proportion of a year or each desired figure. So in our example, we have seen that the payback is happened before the end of the year 4 and after the year 3. So this in between 3 and 4 years. So after the year 3 and before the year 4. So payback is therefore year 3 after the year 3 plus a proportion of a year 4 based on the year 4's net cash flow. So now we are going to calculate how much extra cash flow is needed after year 3 to achieve payback. That means cost less cumulative to year 3. So we are expecting £3,000, and on our third year, year 3 after 3, we have cumulative cash flow is 2,500. That's our 500 is our in between. So apply this figure as a proportion of the cash flow received in year 4. So 500 divided by 4,000, that's the 4th year cumulative cash flow, and that's the previous year, so the 1/4. So that means the payback is achieved 1/4 of the way through year 4, and after the year 3 years after and 3 months. So that means 3 years and 3 months is what the correct payback period time. So here we are calculating the time period according to the payback period. The key points of the payback period is the shorter the payback, the better the project. So the more the reduce the time and the shorter the time, the payback, the better. And then if you use the hurdle, the rate, so like rate of interest, short time hurdles means less project considered and vice versa. That means opposite. We should emphasize on receiving cash quickly, so reduces risk. So it is a risk-free and easy to use and universally understood, so easy to calculate and communicate regarding the payback period. And then it's very tandem by use and with other methods. And time to reach payback, but no overall project life benefits calculated, nothing after payback reached. So more importantly, there is no time value of money, so there is no discounted factor in payback period time. Now next technique is accounting rate of return. This method expresses average annual profits. That's average annual profits as a percentage of average capital invested. The higher the percentage is, the higher the better for the project. And annual profits are profits that's obviously after depreciation, and that has to be added together over the life of the project divided by the number of years. And the average capital is the opening cost plus the closing value, usually 0 as assumed completely written off, divided by 2. That's the average rate of return method by calculation. Sometimes it's called return on capital employed in ratio. So if somebody, investor or the external person, they want to see the return on capital employed, that's the initial capital invested, and when we divide the average profit, that's the operating profit or the net profit per year, and if that figure divided by the initial capital, that invested capital, that accounting rate of return is a ratio of average gross profit, net profits or operating profits to initial capital employed. That can be calculated either way, and that should be expressed by the percentage. So that payback period should be expressed by the number of years, because definitely we want to see which time period are to be taken for return the cost of capital. And the average rate of return is a percentage. So which percentage is the effective percentage to repay the cost of capital. Let's see one example of the average rate of return or the accounting rate of return. So life of a project is 5 years with profits of first year 4,000, second year is 5,000, third year 6,000, fourth year 7,000, and fifth year is 8,000. So altogether the is 5 years profit is 30,000 profit. If we sum up this profit, adding profit consecutively, so that will come 30,000, and cost of the project is 72,000. Now, what will be the profit per annum on an average? On an average in every year, 6,000. That means 30,000 divided by 5. That will be the 6,000 is per annum. Our profit will be calculated, and average capital invested, that is cost of the capital. So that's the total capital has been invested divided by 2, and then there is no rate of return. That is 36,000. Now our accounting rate of return, 6,000 divided by our average capital investment, 36,000, and the percentage multiplied by 100, that is 16.7%. So that is our accounting rate of return for the payback period for the particular time period. So these are the two we can calculate for the non-discounting factor. And the key points of the accounting rate of return, it uses whole of the project life, the rate, and then it stays static. Increasingly less used by organization as NPV much more popular. Used more in basically smaller organizations, they are using accounting rate of return and only usable in a simple decision, not the complex decision, and should be used alongside payback. So if the company use the payback, non-discount cash flow, and then they can use the accounting rate of return. So payback and they are going together, and then no time value of money has been calculated here. So now we are going to see something about the time value of money. So what's the difference between £1 now and then £1 in a year's time? So for after 12 months, what will be the price? Will be the £1, and what will be the present price? So factors changes the value of money, the definite interest, inflation, is there is economic inflation, and other risks to materialize the money. For example, the annual interest rate is 10%, and I lend you the £1 now, and we'll get back after 1 year. 1 year. So that means £1 I'm giving you the money to as a lender with the 10% interest rate, and then how much worth of the £1 in 1 year's time. So if it is £1 today, and after 12 months, what will be the price of the £1? So if it is question mark, what will the price after 12 months? And then if it is 10% interest rate, so 1 plus 10% equal £1. That means the £1 will be value after 12 months will be 91 pence. So 91 pence after 12 months will be valued today is £1. So that's the 10% is called cost of capital. That is the cost of capital, and it's called the discount factor. And this is the discount factor of this cost of capital. So let's see one example of the time value of money. So if £100 is received today and invested at £10 interest, it is worth £110 in 1 year. Simple calculation, simple interest. £10 interest, 10% interest for the £100 money, and then after 1 year it will be £110. This means that I would settle for having either £100 today or £110 in 1 year, because I can invest £100 at the rate of 10% and turn it into 110. This is the simple calculation of the 10%. So therefore, if we take any money received in a year but put into the today, and money we would divide by 8, that's the future money, and then today's money. Future money with interest divided by today's money, which is the same as multiplying by today's money divided by future money, that is 0.909, the calculation, that's 90 pence or 91 pence. So this is now known as a discounting factor. So that's the future money divided by today's money. That's the rate of interest, 10%, and then that's the today's money and then divided by future money. That's the discounting factor. So if you receive £3,000 for that payback examples, so in 1 year time it is equivalent to 91, that's the discounting factor. So after 1 year, so we will for the £3,000, so after 1 year with the 10% interest rate or discounting factor, that will come at £2,727. If we receive 3,000 in 2 years time, if we receive £2,000 in 2 years time, it will be worth at 0.909. That's our discounting factor, because it's 2 years. That's why I multiply 0.909 again. That's 2479. And then the factor is for 2 years is therefore 0.826. That's the 0.826, and factor is 3 years for 0.75. If it is 0.909 multiply 0.909 multiply 0.913, discounting factor when multiplied, that will come 0.751. There is a discounting factor table. I will show you in the next class how you use the discounting table when you calculate the net present value. But today we are going to understand what is the discounting factor and how we calculate the time value of money, and what are the different tools and techniques of the investment analysis. So let's see in another example of NPV. So a company has a project costing 3,000, how this cost of capital is 10%. If it is cash flow, every year, 100,000 pounds. So let's see the present value. So first year is 909, second, and then because we need to multiply the discount factor 0.909, so that's the multiply, and then first year present value for the 1,000 pounds would be the 909 pounds, and then second year the discounting factor is 826, because 909 multiply 909 would be the 0.826, and that would multiply with the 1,000 pounds, that will come the 826. Third year, our discounting factor is 0.751, and that will the present value is a 751, and fourth year is 0.683, and that will be the figure 683. So total present value of the 3,000 pound for the 10% interest will be the 3,170 pound. So each year we are getting end of the year we are getting this amount of money for the every 1,000 pounds, and then total present value of the 3,000 pound of the 10% interest, that will be 3,170 pounds. Now, the net present value actually surplus 170 pounds, because our project costing in 3,000 pounds and 170 pounds is our surplus. So this is actually the overall example of the net present value I have showed you. But the alternative display of the year 0 is undiscounted and added in a total, because here is 3,000 is, and then 0 year the discounting factor is 1, and then for the another year, first year, second year, third year, fourth year, the discounted factor is this amount. So first year the present value will be 0, and then we figure it out as negative figure. So the key points of the discounting factor, cash flow, because we are discounting the cash flow, the key point is it takes time value of money into account, which is very important because time has a value, and it covers whole of the project's life, and it allows for the cost of capital to calculate the proper calculation, and it's more precise, more accurate, but harder to understand. And for the discounting factor, there are two tools and techniques. That's the net present value and the internal rate of return. These are the two discounting factor techniques, and then cash flow and accounting rate of return is the non-discounting factors. So we are learning 4 techniques here. So 2 are non-discounting factors, that's the payback period and the annual accounting rate of return. And the net present value and internal rate of return is the discounting factors, tools and techniques, whatever you say. And the net present value uses the principle of discounted cash flow, which is very much a widely popular method, and the reverse of the compound interest. Future cash flows are discounted back to the today value as you had the money now, and you could invest it and increase it by the cost of capital rate. And it puts emphasis on the receiving cash quickly. So this is the more accurate and more appropriate discounting factor methods on the basis of the project investment. It covers the whole of the project life. It makes the assumption that if money received early, that it is invested at the rate at which it's cost. Cost of finance should not be included in the calculation. It is effectively incorporated by using the cost of finance rate to discount the cash flows. The higher the profit, the higher the NPV, the better. So that means the higher the number of the net present value, the better for the project. Negative net present value implies not feasible, not accepted, although some projects may still proceed. And then if it is zero, that's indifferent. And so if NPV, the result is greater than the zero, suggests the project is profitable and feasible, and if it's less than zero, suggests the project is not profitable. So that means projects typically make an investment at the start and the hope to receive income at various times in the future time. So the investor or the company can assess the worth of the project, calculating the present value of the all money flows, ins and outs. And the net present value is defined as the present value of the all revenues minus the present value of the all expenditures. That's the basic. So present value of the all incomes, revenues and sales minus the present value of kinds of expenditures. So, and then it depends on the discount rate, if it is a multiple years or time are related with the project. So I have said already this one, so if it is equal, if it is negative, and if it is positive, greater than zero, so what will be the impact? And then discounting cash factor or the NPV, discounted cash flow techniques are used in calculating the net present value of the series of cash flows. This measures the change in shareholders' wealth now as a result of accepting the project is equal, so negative or positive. That's the elaboration of discussion. So you can have a look and read and try with some good examples how to calculate the net present value with the multiple years. So normally in the report writing we show. We will show like this, so what will be the present value and the net present value, and what will be the figure of the projected investment. So we can buy a new machine, for example, for £10,000, and the revenues will be after 2 years 7,000, and after 3 years 5,000. So what will be the 7,000 and 5,000 net present value? So that's the discounting factor. So second year and third year, and that's the discounting factor, and that the calculation will be like this. The total total revenues will be 668 on the basis of the second and third year. So this is a typical example of the NPV of a project. And then the application of the payback and waiving method, both useful to make any investment decision by either going to buy a new machine or new building, etc. But on the payback, we can't do the discounting factor, but on the net present value, we can do the discounting factor. All big types organized using net present value, appraisal, measurable cost and benefits, and then helpful to measure the projects is more valuable compared to the other projects. Either you can go for the payback period or the net present value. Now we will consider another technique which is called internal rate of return. If the discount rate was altered continually to a point where the NPV is zero, that rate used to be the internal rate of return. If its NPV is equal to zero, this condition when applied, that rate used to be internal rate of return, and it gives a percentage rate of return as opposed to an absolute figure. So the company would always record an IRR, internal rate of return, that is higher than the cost of capital percentage for a project to be feasible. Invariably calculated on Excel using functions range of, because if you go for the Excel and if you type an IRR, and then you can take the whole of the columns, the figure, and then you will get the IRR figure from the Excel sheet. It can produce strange results if the cash flows fluctuate from negative to positive. So the very strange results rate should always be tested in an NPV calculation. So let's see some example of the IRR. So a company is a project costing £2,000, its IRR. What should be the IRR is the cash flow. These are the cash flow, and because this is for the total cost is 3,000, so that discount factor for the 1 year is 3,000, and for the second year is 0.88, third year is 0.788, There is a table. We will show it as the next lesson. But for this session, we will compare the present value and we will multiply our original cash flow with the discount factor, and then we will see that's the zero, that the net present will be zero. In the other way, we are doing the net present value, which is surplus, is zero. So the discount factors relate to a discount rate of 12.59%, which must be the IRR as the NPV is zero. So if you identify the IRR of any project, we need to see which is NPV is equal to zero, then the rate is effective. So because we will see above the zero factor and under the zero factor, so we will see the different kind of rates are occurring, and then which is exit the zero equal to net present value, then we will take that particular point of rate of interest for our IRR. So that's the example of the IRR. So this is actually the best expression in the percentage and then best use alongside the NPV to help decision making, although the for similar size projects will usually give the same decision as an NPV calculation. And it is quite possible to have a smaller project producing a higher IRR and the lower NPV than a larger project. That's the normal phenomena of the IRR and NPV. So smaller project producing a higher IRR and lower NPV than a larger project. And IRR is compared with the cost of capital percentage, whereas NPV allows for the cost of capital. It is always for the capital percentage and NPV always for the cost of capital. Now, that's we have discussed all about the tools and techniques of the investment appraisal, which is NPV, IRR, and then before then we have discussed about the payback period and then accounting rate of return, which is non-discounted factor. So that is the tools and techniques we can analyze the project and the potential time period for the payback period. Now we can want to see the actually the no profit, no loss point, and then what will be the effect on any kind of business decision, which is called break-even analysis, which is now the cost volume profit analysis. And then this analysis is the study of the relationship between the selling prices, sales volume, fixed costs, variable costs, and profits and other levels of activity. So that's the cost volume analysis, and before we have discussed about the project feasibility analysis, and which is very much related because it's also the break-even analysis also important aspects to see whether the machineries investment or tools investment, whether it is profitable or not, where the department will go for or shut down, where the we want to reduce the cost of the capital, where we want to increase the cost of capital decision. So let's see how the break-even analysis works. So break-even analysis can be used to determine a company's breakdown point, that's called break-even point, and its level of activity at which the total revenue is equal to the total cost. That's very much operational, and then at that level the company makes no profit. So there is a point, the company can identify one point, there is no profit or no loss, that's a very indifferent point, and then company make the decision of the profit margin of safety, and then what kind of profits, what level of cost and profit they want to proceed. Relevant range is the range of an activity in the break-even point analysis which the fixed cost will remain fixed and the total and the variable cost per unit will remain constant. So that's the relevant range. And then in the break-even point analysis, there is a fixed cost level. The total fixed costs are assumed in the production or service industry to be the constant in total. And there is always a per unit cost, and total variable cost will increase with increasing number of units produced. So before we move to the break-even point, we need to know about the graphical presentation. If this is our sales in our x-axis, and if it is y-axis our cost, the fixed cost is always fixed, and then over the fixed cost we have a total cost because this is our variable cost. So this is our variable cost and the parallel is total cost. When we make a line of the sales or revenue from here That's the sales and revenue line that intersects with the total cost, and that point is break-even point. So this line, the sales revenue, should be here. If we draw a line here, then this point or that point, if we think about this one, so when the sales revenue line and the total cost line and total revenue line intersects the one point, that's our break-even point. So this point is our loss zone, and that area is our profit zone, and this is a no profit no loss zone. The total sales revenue will increase with increasing a number of units produced. So that the company should focus that area, because definitely the company wants a profit. So they want to identify the which sales are expecting and budgeted or the forecasted sales on the basis of the cost. And then this is the profit area. So let's see how the break-even methods work. So obviously we can identify the break-even point, and there is a target profit. That's the right side of the BEP point, break-even point, and we need to identify the margin of safety, and then we need to know about is there any changes in components of break-even analysis. So how we can calculate the break-even point? In units and in value, we can calculate two ways break-even point: the fixed cost for the period and contribution per unit, and contribution as a percent of sales. That's the in value of break-even point. Normally, contribution is defined as the excess of sales revenue over the variable cost. The total contribution is equal to total fixed cost. So the calculate break-even point in terms of unit output, you need to know the contribution per unit and contribution per value. So these are the formula of the break-even point. So fixed cost contribution per unit, that's in terms of break-even point in unit, and then break-even point sales revenue at break-even point. If I multiply the break-even point times selling price, then we can get the break-even point of sales. Okay, so these are actually the elaboration of the formula: contribution per unit, selling price per unit, so contribution to sales ratio, and the break-even points in units. This is the basic formula. And for example, if it is selling price per unit £12 or the dollar, and the variable cost per unit $3, and fixed cost is $45,000. So what should be the break-even point? Okay, let's see. So that's the break-even fixed cost is 45,000, and that this line should be here because this is a typo mistake. And the contribution per unit is selling price minus what's that? The variable cost per unit. So selling price minus variable cost per unit. That's the per unit. That's our contribution. So that's the 5,000 units of the break-even point in units. So we need to know about our selling price and the variable cost. Selling sales and the variable cost per unit. That's our contribution per unit, and then we need to know about the fixed cost. Then we can identify or calculate our break-even points in units. And then when we multiply the selling price with the units break-even point, then we will get the sales break-even point in terms of sales. That's dollar or pound, whatever you can, the monetary terms you can focus on. So if you have the units, so and then you have a selling price per unit, then you multiply that units by the selling price, and then you can get the sales revenue at break-even point. So there are the two types of break-even point in units and sales. That's a unit per unit, and then your sales. Then before that, you need to know about the contribution per unit, and contribution per unit is calculated by the selling price less variable cost per unit. There is another alternative method, but I think it can follow one method. You don't need to go the sales ratio. So if you want to do another method, you can do it, but I'm not going to discuss it here. But you can see on your presentation slides, we can have another alternative method. So on the another alternative method, we can have a target profit, and then you have a positive EBITDA to sales ratio, then you can calculate on the basis of this formula. This is actually the marginal costing, because normally we are going to calculate the project costing, about the payback period, accounting rate of return, net present value, and the internal rate of return. And on the basis of marginal costing, we need to see about our break-even point. This is basically actually the fixed cost, a variable cost. I say that this is the parallel of the variable cost is total cost, and then we can see our total sales, and that is our break-even point. And now we will see our margin of safety, because we want to sell our unit after the break-even point here. So we need to see our sales after this point, any point, and this is our cost line, and this is our sales line. So this is our margin of safety, means the extent to which planned output or sales exceed the break-even point, as we have seen in our chart. And if in the party example, one expects to sell 50 tickets, to my margin of safety is 20 tickets, because if you want to see somebody wants to sell the tickets on what points they want to sell the profit in what number of tickets. So normally marginal costing decision comes from product line management, acceptance of a special order, whether they want to buy or they are make, and maximize contribution and therefore profit by examining scarce resources. For example, this is a very important decision whether the company can close or continue. For example, we can take one example here. One sports company is a retail shop company that operates with 3 departments: equipment, clothes, and others. So these are the 3 departments, and all in the same premises. The 3 departments occupy regular equal size areas of the premises. The trading results for the last year showed as follows: sales of the 3 departments, and the cost of 3 departments, and the profits and loss of the 3 departments. Now each department cost include 46,000 fixed costs. So every department has got a 46,000 fixed cost. Now they have one important agenda. Should the other department be closed? So this is because the making loss. So that's why they are thinking to close that department. So if it is 46,000 fixed cost, the variable cost, because we do have a total cost here. So these are total costs, so that should be our variable cost. So 46,000 fixed cost, the total cost, and when we minus total fixed cost from the total cost, that will be our variable cost. And we know our contribution equals is sales minus variable cost. So this is our contribution, and then this is our profit. Now the other department still shows the contribution, so should remain open, because other department, it shows the contribution 37, which is positive, because if it is shut down, that the fixed cost is 46,000 is lost, but here is 46,000 is losing, but here if it is continue, that's a 9,000 only the loss, but and still it's contributing. So when you are going to make a decision on the basis of the production, whether it is shut down or continuing, you need to see the contribution of the unit, and if it is still contributing, then you can have a decision on the basis of the fixed cost and on the amount of the loss. So now there is a decision: the other department should be continue because it's still contributing, because sales minus variable cost, and this is contribution, but the fixed cost is too much higher than the contribution. That's why it's making loss. But if it's shut down, that's make more loss, more hamper to the production or the company. So margin of safety is a measure of amount by which the sales may decrease before a company suffers a loss. And this can be expressed as much number of units or the percentage of sales. So margin of safety, budgeted sales, and then break-even sales. If we minus from one to another, break-even sales from the budgeted sales, then we will get the margin of safety. Or we can have the margin of safety divided by budgeted sales level, multiply the 100, that will get the margin of safety by percentage. So these are the two formulas we can calculate the margin of safety. And then if you have this graph in your mind, this is a break-even point, total cost and total revenue, the intersection point, and then you have a margin of safety. A simple graph in your mind, and then you can make any decision, because any decision come from here that you should do any sales cost and sales from this point of after the break-even point. So again, that example, if we see that we have a selling price per unit $12 and the variable cost our $3 and the fixed cost 45,000. And we have a target profit 18,000. So we have to compute the sales volume required to achieve the target profit. So target profit is our 18,000 and the 45,000 is our fixed cost, and then our contribution is selling price minus variable cost per unit sales, per unit variable cost. So when we divide these things with the fixed cost and target profit, and then we will get the target profit of number of units. That's the 7,000 units. That's the units of target. If you need to do the target profit of $18,000, then we would need to sell 7,000 units. Or in terms of sales, we multiply selling price $12 with the units, and then we need to have $84,000 for getting $18,000 profit. So these are a simple calculation. You can have it, and you can do some mix and match what kind of target profit you want to do for your in terms of unit and in terms of your sales. That's the margin of profit, the margin of safety. That's another alternative method. You can have a look. We can take the contribution to sales ratio, take the ratio percentage, and then you can have this kind of same figure, but the alternative way you can have this figure as well. So see, let's see another margin of safety example. The break-even sales level is 5,000 units, and then the company says the target profit is 18,000, and the budget sales level is 7,000 units. So again, so if it is a break-even level is 5,000 units, so that's another example to other way to do the margin of safety. Because the other example was a target profit, and this is a margin of safety because already we have a target profit, and then we have a break-even sales of 5,000 units. Okay, let's see margin of safety is in units and expressed as a percentage of budgeted sales revenue. So budgeted sales revenue level in terms of units is 7,000 units, and then our break-even sales unit is 5,000 units, and that's margin of safety is 2,000. So budgeted 7,000 units, and then break-even is 5,000, and the difference is 2,000. That's our margin of safety. Other way is our 28.6% budgeted sales level, and then that will come to 2,000. That means the margin of safety indicates that the actual sales can fall by 2,000 units or 28.6%. Budgeted sales levels, that's the 7,000, and margin of safety is 2,000 units. That will come to 28.6% from the budgeted level before losses are incurred. So that's the most important thing when a production manufacturer are trying to see what the production level is going on the basis of margin of safety, what is the break-even point, and what level of production and cost and sales need to do in the production line and the company's decision. So it is the same as similar examples, and then if the selling price is raised from $12 to £13 here, so we see that we increase $1 from $12 to $13. So we increase $1. The minimum volume of sales required to maintain the current profit will be. So if you increase the selling price, let's see the let's play with the numbers. If you increase the selling price from $1 from previous price to the current price, and then what will be the minimum volume of sales required to maintain the current profit will be. So we know our target profit is $18,000 and our fixed cost is $45,000. Now our selling price is here £13, and then here our current profit will be, and our targeted profit units will be 6,300 units, which was before 7,000 units for the £12. So see, look at the difference, because when we increase £1 from £12 to £13 for the selling price, the units, the sales units will be will change. That's 700 units reduced from the 7,000 unit. 7,000 units, 700 units reduces 6,300 units, or the margin of safety when we increase the price of the selling price. And again, if you change the variable cost, so before it was a $3, now it's a $4 per unit. If the fixed cost fall 5,000, so it was before 45,000, now fall 5,000, 40,000, and the variable cost rise. So reduce the fixed cost and then increase the variable cost, and what will be the units outcome? So that will be the good unit. 7,250 units should be the margin of safety. That's the increased units. So that's the way a company or financial analyst can make a decision on the basis of the margin of safety break-even analysis, break-even point. From the break-even analysis, you need to know which point he needs to move to further way, and what kind of margin of safety a company should maintain for the production and for the target profit, and what kind of break-even sales in terms of units, in terms of sales, what kind of point of break-even point the company should be maintained for this purpose. So that's all about investment appraisal. So we have learned today that there are 4 different types of investment appraisal: payback period, accounting rate of return, which is non-discounting factor, and when we discount, take the factoring discount, then we will take the net present value, which is included the time value of money, and the internal rate of return. So that's the investment appraisal analysis. And then also we did a break-even analysis in terms of margin of safety and the target profit. And then we have to accommodate all of things in our assignment. So which is task 3, you have to read carefully all the terms and conditions of your assignment, and you have to download the Samsung PLC published account, and you need to accommodate something with the assignments with this project. So if you have any query, please email me. This is my email address, and if you can always call to our office. And I available most of the weekdays in the office from 10 o'clock to 4:30 p.m. If you have any query, just do email me and then call me to our office, and you need to submit your assignment as soon as possible, because without starting your first draft, I can't make any comments, but I need to see how further you are going on your assignment, and how are you doing your finance or strategic managers, because the whole learning outcomes are based on the numerical terms and quantitative methods. So you need to do some formula, and you need to do some theory with the basis of some calculations, and you need to do some feedback with your tutor. So I'm expecting your email as soon as possible or any phone call. And that's all today's discussion about the investment analysis. Thank you very much and good luck.